Hi, all Ben here from East West. Haven't done a video for a little while, but I thought I'd just take a look at the S&P here now. The S&P's been a struggle, I think, for everybody who is trying to apply Elliott wave to it at the moment. I think the counts are fluky at best. I mean, there's problems with the structure in here. It's not going together very well. Right now, what I've got here is my best guess of what's happening in an Elliott sense. That, oh man, and even to make this sort of impulse down here, and then I would expect now that we're going to get, I mean, this is an impulsive rip, that we're going to get three waves back up like that before we turn back down. So even though for the moment I'll remain bullish just in the short term, because I just think we're going to get three waves coming back, but this, it's still difficult to categorically say that this is an impulse. So, you know, a lot of things remain very, very open to interpretation, as they always do with Elliott. But this market's so super flicky. It's hard to get a read on it. So, you know, one of the things that you do when the market's like this, if in doubt, we zoom out. So I'm just going to put the Elliott aside and just have a look at a few different things and see what we can come up with. So what I've done here is I've just come out to the monthly chart, and I've just put on the credit cycle, the 18 to 22 year credit cycle, which I've taken shamelessly, just borrowed straight off Malcolm at Norvast, who is the OG of the cycle world. At least I think he is. For some reason he's got some detractors, I don't know why, but nonetheless, the way this is mapped out, and this is what Malcolm said, is that he's expecting that we can see here that we came up and made the half credit cycle high in March 2000, and we've got another one here in January 2022. And now we're looking for this half credit cycle low. Now, this is what, you know, Malcolm's expecting, that there's going to be the half cycle low is going to come in sometime this year, and then we're going to go on the multi-year rally, you know, 26, 27, while we seek out the credit cycle high. So, you know, we're going to come off and we're going to do something like this. And when you look at it, this is in log scale. I've just put it in log scale because it just presents a little bit better. But when you sort of look at the last credit cycle low in 1990, you can sort of see possibly that there's similarities that could be going in here, where we've got this run, but this doesn't look quite deep enough, even though 31 months. So what we'd be saying here is that the 31 months is every 3 to 5 years we get another cycle. So as things sit, we're 163 months from the March 2009 lows. Okay. So I've just come back out of log scale because I think just down here, this credit cycle went for 18 years and 5 months, and this next one we're 14 years in as of the start of this month. So Malcolm's still looking for the half cycle low. So you would say at this point, this October 22 low becomes a contender. But I don't know why Malcolm thinks that there's more to come, why this isn't it. But really, I'm still trying to learn more about cycles as I go along. So hopefully whatever I present here to you is just something that you can take to help you learn a little bit more, because I'm not that far down the track. But if I can show you what I've learned so far, to help you off, then that's great. So whether or not this is going to be the half cycle low for the credit cycle remains to be seen, but Malcolm thinks that there is going to be more to come. And my Elliott wave analysis overall suggests that yes, that this October 22 low is not the ultimate low, that we're going to get another low somewhere in here this year. Remember on a monthly here, but we're going to get some sort of low in here this year that's going to make the credit cycle, the half cycle low, before we go up. So we just come in to consider the weekly cycles that we've seen, and some of this is a bit different. There's a bit of conjecture as to whether or not this is actually a weekly cycle here, an ICL. Malcolm doesn't have an ICL. Alex Dailowski, the other cycle guy I follow, does, which sort of changes the stuff down here. But there's a bit of differing opinion going on here, because whether or not we've done enough here to make this an ICL, I mean, I think if this becomes the ICL, then this becomes quite a significant low, and then possibly does then become the half cycle low in the credit cycle. at 31 months since this last big low here. And that would mean that we're on the way. So, right now we're still dancing around the idea. Like I said, I've just got to defer to Malcolm at this stage because he's the guy. So he's expecting this to come down a bit more, maybe something like this. But the 1, 2, 3, 4, 5. That we wouldn't expect too many more cycles, and that's something else that sort of plays in the favour of maybe this is low, because 1, 2, 3, that's 5 intermediate cycles that have come in to make up potentially this yearly cycle. So I'm not going to take this low out. So, well, I hope not. So, yeah, it's still a little bit fluky even in this regard. But like I said, I've got to defer at this point to Malcolm, because he's all his years of study is telling him that this is going to come off one more time. So, yeah, you could even say the cycle just at the moment it's not 100% clear either. Well, what is looking clear to me, just as we sit, is that we've got a daily cycle low's been made here on the 2nd of March. Now, I'm somewhat hesitant because for some reason Malcolm doesn't think that's a daily cycle low. To me, that's what it looks like, and that this would be daily cycle 3. But if this is going to be daily cycle 3, if this is going to fail, well, then I'm expecting something pretty quick. So when we think about what's on the horizon, we've got a few risk events pretty close by. That being, we've got power talking very shortly. I'm not sure that's going to rock the boat too much, but we do have CPI on the 14th, and then we've got these dates might be not right depending on where in the world you're looking from, because this is kind of set to old Sydney town time. So, we've got that CPI coming up and the FOMC. So, in that Elliott sense, I'm just wondering if we sort of, we come up, we come down, and then some, on one of these risk events that we turn back down. So maybe that top doesn't get taken out. And then we get a left translated and a failed cycle. That's kind of what my gut's telling me is going to happen, but it's not. It still remains unclear. So what is clear? Well, the only thing that's really clear to me is, I go back to just my Ichimoku overlay, is that we're still not through this cloud. Okay, so we still haven't broken the back of this downtrend. And whilst ever we remain under this cloud, I'm expecting more downside. If we can get to the other side of this cloud, if we can get up like this, somewhere up here, maybe not quite like that, you get the point. If we can get somewhere up here, okay, well then I'm coming back here and I'm saying, okay, well, I've got to think about this being a major low, and can I put that together? And yes, I can, because I've always got backup plans. I've got backup counts. I've got bullish scenarios where, can I make this go together to be bullish? Yes, I can. But I think as it sits, that we've got some sort of impulse. We're going through some sort of correction. We'll get one more impulse down. But nonetheless, weekly Ichimoku charts, very, very good on that broader sense to just give you that clue that we've done enough time-wise to get through and break the back of this downtrend. I mean, you can see these little periods here, but really the last major period we had of a heavy red cloud is back here, okay, back in 2009. And once we got on the other side of that cloud, we were good to go. But until then, we remained bearish until we can get through it. The other one is here, 2001. So the point being is that when these weekly clouds break, especially when they've been going one direction for a long time, it's not nothing, okay? So until I see, I know we sort of broke here, but, COVID, and look what happened off it. But until we can break through this top here, I remain bearish. I just remain bearish until the price action can get above that cloud. Okay, and one of the things that we'll see is that what we call a Kumo twist. So at some stage out here in the future, and the price might actually get through the cloud before this happens, but if we see this cloud start to twist and start to turn green, we know that there's enough momentum building up here. So just to finish up, could this be it? Could we be looking at a one wave up, two wave back down, 1, 2, 3, 1, 2, 3, and this is, people have counted this as an impulse. Difficult, but there's another solution that I've seen out there where this is actually one of the most disgraceful flats ever to grace Elliott Wave. But the point being here is that could we be potentially witnessing this? Sorry, I just had to do a bit of rejigging there. But 1-2, and now we've just got 1-2 again. We know that the 50's moved above the 200-day moving average, and that the 200-day moving average, unless I'm drawing it wrong, I don't think so, but the 200-day moving average has caught price on the other side. Now, what else have we got there? Price came up and retraced exactly to the 61.8. This is using the SPX. If you use the mini S&P, it's broken, but on the actual index, we came right back to the 61.8, and I think you could safely say that's a strong reaction. That would set up your pitchfork trade where you would be looking for price to get to the median line and then potentially tie that into the measured move. But you can sort of see how that would go together. However, I think in an Elliott sense that that would blow the idea that this is going to be 1, 2, 3 out the door and then we come back down. That would kill that idea, I think. So to me, just forget about the Elliott, which shouldn't be a problem for most of you because so many people dislike it. But that's just the clearest thing right now for me is this retracement to the 61.8, and then we're just going to stay bullish. And if I just pull this one out of the way, you can see that there's another one here in the retracement zone that's still ongoing, even though this has fallen short of its target. But you get the point. At a very basic level, the market's done this, and if it takes out this top again, well, just look at the structure that you've got. It's bullish. So I don't know. So just to sum up, I don't think the Fed's done raising rates. I think the chances are that inflation's going to stay and employment's going to stay up higher for longer, and that they're going to have to do more than what the terminal rate's currently priced at. Now, at some point in time, and I think what would have to happen for this to sort of play out the way that I'm thinking is that CPI number when it comes out would have to be god awful. Like if it's really, the Fed's talked about, the deflationary sort of aspects coming in and that inflation's easing off. If that starts cooking up again, well, there won't be anywhere to hide. So that's just, I know that's not very helpful, but things just aren't super clear. Like that's just the clearest thing that I've got at the moment. So short-term bullish, but I remain a bear. So that's it. I'll update stuff on Twitter as it comes to hand. But for right now, as long as we're sitting like this above the 10-day moving average and we're trending up, you don't take on the momentum. You just let it run out, let it get to the top, let it run out of puff, and then we'll think about taking a short. All right, that's it. Thanks. Bye.